Welcome back, everyone, to Vox Markets. My name is Paul, and I'm delighted again to be able to speak to co-CEO Frank Hanna and CFO Ryan Mahoney of Michelmersh Brick, a leading UK brick maker, with premium brick maker, in fact, with around sort of 5% of the market. So welcome, gents.
Hi, Paul.
Hi, Paul.
Well, big congrats on today's storming set of first half numbers. I mean, the company's literally blowing the ball out of the park, even exceeding 2019 pre-pandemic levels. So, Frank, I don't suppose you could quickly walk us through what the sort of what's been driving that performance and sort of the key highlights of the first 6 months.
Well, you know us, Paul, we like to just slightly under-promise and slightly over-deliver. Yeah, we've had a very strong, robust order book. We've tried quite hard to sort of convert as much of that as we possibly can. It's been very well balanced. You know, we've had very strong RMI, some good housing sites that we've been delivering to. So that's been very positive. We've got some infrastructure projects and we've got some decent commercial work as well. So it's been a good blend of orders down the road, really.
And have you seen any softening off of the market at all in terms of the stamp duty sort of being withdrawn over quarter three? I mean, obviously that drove quite a lot of house building to complete up until the end of June, when the first sort of like tranche of that benefit was taken off. But have you seen that? Has that played out at all, or was he just giving you a bit of a chance to replenish stock levels?
No, we haven't. It hasn't slowed things for us as of yet. That may change later on as you move into next year, potentially. I think the other one to watch is the change in the stamp duty at the higher level from October onwards. That may have an impact in the top end housing market.
Yeah.
But at the moment, you know, we've got some very good visibility on our Q4 and Q1 of next year order book, and we know where we are and what we're doing. So, and it remains pretty robust.
Yeah, and Ryan, I noticed you managed to keep the operating or the profit margins roughly equivalent to 2019 levels on the adjusted level, which is a pretty good performance given the cost inflation, particularly on things like energy and raw materials and labour, and probably having to run the factory on overtime and all that kind of stuff. Can you talk us through the sort of where you see the cost inflation and supply picture at all?
Yes, thank you, Paul. Actually, the first half's been very strong. Actually, the EBITDA margins coming in above 25%, which is ahead of what we see as a sort of the longer term, medium term expectations for EBITDA margin. I think the first half, we've got some very strong operational leverage. Revenue of 29.9 million, which is 10% up on the pre-COVID 2019, which is a record year for the business. What we're seeing is, to really answer your question, what we're seeing is some of that coming through potentially more in the second half. Everyone's heard about the pandemic. Everyone was disrupted at the start of summer with some of that labour availability. You know, the haulage costs are all over the media at the moment. So we're seeing, as Frank said earlier, a slightly more risk in the second half. So we see some of those margins coming off slightly from this first half to sort of give a more sort of normalised view. And in the statement, you'll see that we've talked to sort of 100 basis points dropping off in the second half. And that's really some of those costs that you just alluded to, potentially coming through in the second half. And as Frank said, we've just got to look out with a bit of caution. We just don't know what's around the corner, as we've all experienced over the last sort of 18 months of COVID uncertainty.
Yeah, and with that crystal ball then, Ryan, I guess you're putting a bit of pressure on Frank to sort of increase selling prices at some point in time. So if we could just Frank, how is the sort of the pricing perspective? I know when we talked last time, most of the industry was sort of baking in 2022 because it was annualized contracts. But how are you seeing that at the moment, given the exceptional level of tightness in supply? Particularly, I mean, you can't even get a truck driver or even a pot of paint at the moment down B&Q.
Yes, true. We are looking at our prices for 2022 as we speak, and we'll go to the market with our price increases at the end of September, which will be for the 1st of January.
Yeah.
We know that some of our competitors have applied some price increases as of 1st of November and the beginning of January. But as a business, we like to try and give steady pricing structures But we don't fix our prices for full years.
Yeah.
You know, for a whole year at a time, we try and do them incrementally with a 6-month break. But yeah, we're going to notify the market on price increases tail end of September in readiness for the 1st of January.
Yeah, and Ryan, what's the current brick inventory levels in terms of stocks? Obviously, you know, you've delivered massive amounts of bricks in the first half, and you didn't have too many heading into the year, because I know Frank had run a pretty tight ship up to that point. So you must be sort of like you know, thinking about having to try and replenish some of your inventory, I guess, over the next 6 months.
Yeah, no, that's right, Paul. And as you know, we try and sell everything we make. So we try not to sort of sit on too much inventory, although clearly that gives us flexibility of order fulfillment. I mean, industry-wide, we're seeing stocks of below 300 million.
Yeah.
Which, when you look at sort of national capacity across any given year, of just below that 2 billion mark, you can see that stocks are getting low.
Yeah.
And again, going back to one of your previous sort of questions, that second half, we don't have as much on the ground as we would like to give us that total flexibility of fulfillment. So again, it's another one of those reasons why simply timesing the first half by 2 is not the right way to look at these results, albeit, you know, we're very pleased with them.
Yeah, and then sort of like bigger picture, Frank, in terms of the bringing on extra capacity. I know we've touched on this, and this sort of like things irons in the fire, sort of longer term and projects and stuff. And I know I did notice from the statement that you're looking to expand certainly the mineral resources at Telford and places like that. How do you see that sort of working through going forward over the next sort of like 2022, 2023, 2024, bringing on more capacity if that's possible?
Yeah, so we look at things in 2 ways. But firstly, coming back to your point vis-a-vis mineral, it was important to do that. So we under mineral availability at Blockleys, our plant up there is a key plant for us, and also down at Michelmersh, which produces the beautiful orangey red bricks that you see in the top end developments. We've always got something on the drawing board where we can improve efficiency, or we can bring some extra bricks to market. We have got a project, we're deploying £1 million at the moment to try and improve some efficiency at our carton plant, and that'll give us some more drying capacity. So that then releases a bottleneck, if you like. We've got everything in unison. And we're looking at other opportunities that will work in terms of bringing a little bit more capacity to the marketplace. If we can make those incremental adjustments upwards throughout the year, we will do that. We've got a few things on the drawing board at the moment.
Yeah, and then Ryan, you mentioned on that there was about 300 million units on the ground across the industry, with a sort of like a industry production capacity just in the UK of about 2 billion. So just doing the maths, that's roughly what, I don't know, 8 weeks or something like that, or 9, which compared, I think that historically it's about 15 weeks, I think it is, has been in the past. So we're extremely tight on the ground across the UK. What's that meaning in terms of imports? Because I know most of the imports brought in are sort of like the premium end, but it seems as though they're not really making much of a dent either. Is it that they're not coming over because the continent is in the same position? Demand is going through the roof.
Frank might be able to sort of take that question.
So if you look at the imports, they have dropped off a little bit, but we think Q3, Q4 going into H1 of next year, you'll see the imports coming back up again, without a shadow of a doubt. I think our total UK output capacity is around 1.9-ish billion at the moment. So this is the lowest industry stock we've had since record began. And if you go back to 2008, 2009, you know, we had industry stocks up at over around 1 billion and production capacity up at 3 billion. So a lot of capacity is being taken out. And you've got some of the bigger manufacturers also refurbishing existing plants they've got, so they've had to take out a little bit of capacity in order to do that while they go through the transition. So I think there is going to be pressure brought to bear in terms of sucking in some imports. And at the moment, as Ryan alluded to, any bricks that we are producing in the second half of this year are pretty much allocated to go straight out. So that it's nice to have a little bit of stock on the ground. You can then be quite flexible around your production processes. It does create a few hurdles having no stock in terms of your production planning.
And what about the sort of flooring? Because I know that was sort of like part of a sort of like an optionality. So obviously, Florida was the acquisition you did, I think, back in 2019 that increased capacity. Was out in it's in Belgium, isn't it? I think it is. Yeah, and some of that, is it possible to bring some of that out, some production, or alternatively? Because I mean, obviously, you've had a terrific first half in terms of sales and profit, but also your cash now. You're in a very strong net cash position. Plus, you've got sort of debt capacity. Is there an option to potentially a bit of M&A to bring on a factory, maybe even on the continent, to bring bricks in?
Yeah, so if we split the question into two, firstly, yeah, flooring has been great. It's integrated very, very well. We've launched a couple of UK-centric products, and we're already seeing some good demand for that. We started producing them about 6 weeks ago, and we've just been shipping them over the last few weeks. So there's a significant level of flooring-produced products coming to the UK to fulfil gaps that we see in UK demand that suits UK vernacular.
Fabulous.
That's going quite well. The team worked quite hard over there, turning around a couple of key new products. You know us, we like to have a bit of a cash pile because it makes you fleet of foot. It also,
you generate so much of it.
Well, when you have it, you know, there's a couple of things as well. We wanted to return to the progressive dividend stream. It's important to reward shareholders that have been with us for a while, you know, and that will take, I mean, Ryan talked about how much we're paying out in relation to cash, percentage-wise. But when you've got cash, it gives you the ability to be quite fleet and do and seize opportunities as they present themselves. You know, us, we're always looking for something that will work with our core competence. So,
and what sort of the investment side of that of the cash then, Ryan? Or what are you looking at anything else at all, or is it basically just a bit of it's organic, and if there's really it's opportunistic on the M&A side?
Yeah, I mean, as Frank just said there, I think we see the strength of our balance sheet as providing the right options for us.
Yeah, okay.
We are absolutely making sure that we stay well averse with all opportunities that meet both our financial criteria and, as Frank said, meet the sort of the skill set that we have as a management team. You know, clearly we've got nothing that we can sort of talk to you about today, but I think the main thing for us is that, you know, we make sure we've got the right balance to be able to inwardly invest, make sure we've got well invested and, importantly, efficient manufacturing facilities. But also, as Frank said, we are very pleased to announce today that we've returned again to that progressive dividend policy. Last year, we were very pleased to be able to do a final dividend of 2.5p, and the interim dividend here at 1.15 pence per share puts us back on where we would have been if the 2019 trajectory hadn't happened. So, you know, I think that's a really important commitment, and all of that really does require that stable cash flow generation. And that sort of 90% conversion of adjusted EBITDA is where we see our natural target of the business. So, you know, that you can really then see the potential of the business.
Yeah, and Frank, just in terms of sort of like, you've obviously got the new build and you've got RMI, which are obviously going very strong. Just the sort of other, perhaps even longer term, or maybe even the starting to feel things like build to rent, and then you've got the recladding of, you know, sort of Grenfell Tower thing, and you've got new railway stations at HS2, and, you know, the repurposing, obviously, vacant office and retail stuff. And so, I mean, you've got quite a lot of, the industry's got quite a lot on its plate in terms of future demand, I'm guessing, for bricks.
There's a lot of opportunity. As you say, office to residential. We've got some very nice infrastructure projects on the drawing boards at the moment. So I think when you look at that and balance it with the RMI and housing, it's a nice picture.
Yeah. You know, and when you talk about it, I think it was the fundamentals are very strong. Could you just give us a bit of colour on that? Because if you add what we've just talked about, plus if the government ever actually can meet its promise of 300,000 new houses every single year compared to about 200,000, the industry has really got I mean, the tailwinds behind the industry are incredible.
Yeah, I mean, we've got, you know, you've got a growing population, aging population, you've got more single occupancy, you've got greater housing formations and housing completions, you know, so there's more of pressure on the housing market, and this is what drives, you know, the house prices in the UK. I think it's a very commendable target, 300,000 units per annum. But will we hit it? Certainly not in the short to medium term, in my view. I think the best we've done prior to the last large recession, our run rate was around 100 of new build, around 195,000 housing starts for an average, 4 years on the bounce. I think we peaked at that 211,000 units when we had a lot of apartments, things on the PPG3. So it's a challenge just getting to 200,000 units, and the sector is very, very busy at 200,000 units. Would I be disappointed if the sector remained at 200,000 units or even 190,000 units for the next 5 years? Absolutely not. I'd be delighted. So that speaks volumes in itself,
Yeah. And I'm guessing sort of, the market as well, what we've seen through the pandemic is people really in the RMI space, sort of upselling or premiumizationing their own properties, and in the new build likewise, people want to live in a good house. So actually the market's moving more towards exactly the premium bricks, presumably, that Michelmersh makes as well, rather than you sort of like just your sort of like grey type of building. The people want to live in an attractive property.
People are far more aware of their built environment. It's one of the investments in their lives, and they look at the sort of curbside appeal and the built environment, and they want it to look as good as it possibly can. And there's a compelling argument from a sustainability perspective for the use of brick. As I've said to you before, when we spoke before, we launched a campaign to think longer. And Ryan put a bullet point in the slides with regard to COVID-19 Chase for Space. We're seeing a lot of people, as well as doing home offices separate to their houses, also putting extensions on. And that has really driven our, I think that with the backdrop of the lower interest rates, that has really driven our bulk sales to our builders merchants, driving our RMI portfolio of products, and that's been very good. And that looks like it's set to continue through 2022, that shadow of a doubt.
Yeah. And when do you think that this big industry supply and demand will ever get into balance again? Is it going to be sort of 5 years, or I mean, who knows? I suppose. But there's okay. Oh well, just then Frank, and then finally, what's the sort of news flow going forward? Is it the standard? You got a trading update towards the back end of this year to do the full year?
We will do, yeah. As per usual, we will do, and then we will go out and do full year in March.
Okay, great.
Yeah, Paul, I think we'll do a pre-close trading update in the back end of November.
Okay,
which will be the next sort of formal set piece you'll hear from us.
Okay, well, brilliant set of results. Big congrats, guys. It's certainly sort of like to be well exceeding pre-pandemic 2019 levels, which are records anyway. It just shows everything of how well the business is doing. So really well done. And I would say to investors, if you want to get the news flow straight into your inbox, just hit the follow button on the website and you'll get everything, all the commentary there as well. So thanks very much, guys, and really well done.
Thanks, Paul.
Thanks, Paul.
Cheers.